Thank you for joining our class today about 1031s and opportunity zones. I'm excited. We have a great panelists today, and it's going to be a good time. So we have Carol and Hudson with us, Molly and Keith. We have Riggs and Ingram with Anna Marie and Christy. And then we have Ryan Bodie with Land Home Financial Services. And we also have Summer Holt with us too. So Molly and Keith, I think we're going to start with you.
All right. Thank you, Rob. My name is Keith Carroll. I have with me Molly Brannon. We're the partners of Carroll and Hudson. We're a local real estate firm that has clients throughout the Panhandle. We started the firm about 1.5 years ago, and one of the first things that we discussed, I noticed that there really weren't a lot of law firms locally that were acting as qualified intermediaries for 1031 exchanges, but I had a lot of realtors and real estate investors asking if we did them. So we discussed it and thought it made sense. Hey, there's potential here. There's a need. So we started doing those probably about 1 year ago, and we've been fairly busy, especially as of late. So that's good. But we'll go through a couple slides and we'll try to pass on some knowledge to everybody. Everybody got the PowerPoint up?
Here we go.
Yes.
All right, what is a 1031 exchange? To keep it short and simple, it's just a powerful tax deferment strategy typically used by real estate investors. The whole point is to defer your capital gains tax. Usually you're going to defer it until you're at a lower salary than you're currently at. That's the idea. But that's the point, is to do the tax deferment.
So the first part we're going to talk about 1031 exchange is a qualified intermediary. That's what we as Carroll and Hudson act as during the 1031 exchange. Essentially, we sell the property on the relinquished property on your behalf. We buy the replacement property, and we hold the funds in an escrow account in between. Luckily, there's and we'll discuss this in a few slides, what's called direct deeding. So you would close just like you would with any other transaction. It kind of helps avoid there being multiple deeds of conveyance going on. But
all right. There's 4 types of 1031 exchanges. It's simultaneous exchange, delayed exchange, reverse exchange, and construction exchange. Since we're trying to keep things kind of short over here, we're just going to go over the first 2 because those are the most common that we come across right now. The simultaneous exchange happens the same exact day. So you're going to sell your relinquished property, and on that very same day, you're going to purchase your replacement property. It all happens right there on the same day. The delayed exchange is where we get into having to identify your identification period, which is 45 days, and then your closing period, which is 180 days. That's the delayed portion there.
All right, so here are the 7 general rules for a 1031 exchange. And we'll go through a slide for each of these. But rule number 1, it has to be like-kind property. Number 2, has to be investment or business property only, no homesteads. Rule 3 is that the property that you're buying has to be of greater or equal value. Rule 4 is you can't receive the boot, is what we call it. Rule 5 is the same taxpayer. And then rule 6 and 7 are your timelines, your 45-day identification period, and your 180-day purchase period.
So rule number 1, your like-kind property. The Internal Revenue Code defines it as no gain or loss shall be recognized on property held for productive use in trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use or productive use in trade or business or for investment. So basically what they're telling you is that the property has to be for investment, trade, or business purposes. And like he said on the prior slide, that means no personal property, no homestead property.
That also means with the like kind, I've had somebody ask me if they can take money that they sales proceeds from a property they're selling and purchase interest in an LLC or any sort of business interest. That won't qualify for 1031. It has to be real property that you're exchanging for. So, and like Molly was just saying, rule number 2, it has to be investment or business properties. So your homestead does not qualify for a 1031 transaction, any primary residence. No flips. I get this question a lot, especially after Hurricane Michael. You know, you have a lot of people buying and flipping property, and they're wanting to 1031 it so they don't have to pay the taxes. Unfortunately, the IRS, what they say is that a property purchased solely to exchange for other property where the clear intent was resale and not investment, i.e. flip home, then the transaction is ineligible for a 1031 tax-deferred exchange. With an investment or business property, and I'll let Ann correct me if I'm wrong, preferably you want to own the property for 2 years. 1 year is all right. You also want to be able to, it's preferable to show revenue that you generated from that to show that it is an actual investment property. But like I said, make sure you have this conversation with your accountant and that they are okay and approve of the property you're selling, that it qualifies for a 1031.
Yeah, Keith, I'll add to that. You know, there is no defined date, but we typically like to see it on a tax return. There's a lot of times it might just be that we at least want to see it on a tax return, and it's like we don't want that to be your personal residence in March. We shift it in, say, April, and then all of a sudden we're trying to do a 1031 that year in December. So it's really nice to be able to see it in its form, in its correct form, right there on a tax return for at least a year. And like you said, 2 years is nice.
Thank you.
All right, rule number 3. This one gets kind of complicated, so I'm going to just give general terms here, and then if anybody has any questions, they can reach out to either one of us directly. We can kind of go into more detail. But rule number 3 is greater or equal value, and the identification rules are the 3 property rule, the 200% rule, and the 95% rule. Under the 3 property rule, the exchanger may identify up to 3 properties regardless of value, as long as he or she acquires one of the 3 properties as the replacement property within the 180-day period. For the rule number 2, the 200% rule, the taxpayer wants to identify more than 3 properties, then he can use the 200% rule. This rule says that the taxpayer can identify any number of replacement properties as long as the total fair market value of what he identifies is not greater than 200% of the fair market value of what was sold as the relinquished property. And then the 3rd rule is the 95% rule. This one's not commonly used because it's complicated. The 95% rule is then a taxpayer can identify more than 3 properties with a total value that is more than 200% of the value of the relinquished property, but only if the taxpayer acquires at least 95% of the value of the properties that he identifies. Basically, the taxpayer will need to acquire everything that he has identified to make this work, and that is what's not usually used. So anyway, like I said, that's kind of, the first rule is straightforward. That's what we see almost every single time we do one, but the second 2 get a little bit more complicated. So if that's something that you're looking at doing, just we can go over it in more detail another day.
All right, so rule number 4 is you must not receive the boot. And when I say boot, I mean the amount that you potentially pay for capital gains tax on. The general rule is that for complete tax deferral in a 1031 exchange is by replacement property with a value that is equal or greater than the fair market value of the relinquished property, less closing fees, and to reinvest all the net cash received from the closing, the relinquished property into the replacement property. So, for example, if a relinquished property, say, has a fair market value of $1 million with a $200,000 mortgage, Capital gains could be completely deferred on the 1031 with a 1031 exchange if the replacement property purchased is worth at least $1 million and the investor reinvests all of the $800,000 in equity. The debt of $200,000 on a relinquished property can either be replaced by the same amount of debt, meaning you can go out and get another mortgage for the same value, or you can come up with your own cash and put more equity into the deal. As for the gain, it is the difference between the sales price and the price originally paid for the property. So in that example, the investor originally purchased the property for $600,000 and is now selling it for $1 million. The gain is roughly $400,000. If the investor decides not to do the 1031 exchange and no other tax exemptions apply, that tax would be owed on the $400,000. I think I got this question the other day whether or not someone could receive a partial part of that boot. So they wanted to invest, say out of $40,000, they want to invest 20 into a replacement property and take the other 20. I'm going to tell you that, again, defer to your accountant because we're not tax lawyers, we're real estate lawyers. It could trigger some violations of the Safe Harbor Act and potentially determine that the entire exchange is invalid. So it's risky. We would do it, but that's something that you would want to do at your own risk. So.
Hey, Keith.
Yes, ma'am.
I can speak to that a little. I do have some clients that typically might not invest all. It's important to look to the proceeds. Any unspent proceeds, you compare those to the gain, and you have to tax any unspent proceeds. So a lot of people don't realize that the transaction, if the numbers don't fall in line, it's not worth it. I mean, you are kicking this tax down the road. It's deferring, it's not getting rid of it forever. But it's important that you understand what those unspent proceeds are. So if in your example, we have $800,000 to work with, if we decide to not reinvest with 800 and instead reinvest with, 500, you've got to look to that unspent proceeds and compare that to the gain. And it might not even make the transaction work.
Correct. And on that note too, one thing that I do want to point out, because I've had this issue come up, is with the proceeds. Say that you don't spend all the proceeds, and you want, so you spend $600,000, and you want the $200,000 back. Once you've completed the sale of the relinquished property, and those funds are held by the escrow officer or by the qualified intermediary, we can't release any of that money for at least the 45-day identification period. We've had people get really upset with us because they're like, we don't want to do this. We want to cancel the 1031 altogether. We should be able to get that money, but there are Treasury regulations that that we violated those by letting that money go early. We could lose our status as qualified intermediary, which we're not willing to do. So I think it's important to let your clients know that if they need that cash now, they may really want to reconsider doing a 1031. Otherwise, they could be waiting that 45-day period to get any of that cash back.
Rule number 5, same taxpayer. So anybody can be the exchanger, whether it's an individual, husband and wife, an entity, partnership, LLC, trust, corporation. But to me, the same taxpayer requirement, the title has to be the same for the relinquished property and the replacement property. This is where the title backgrounds come in to mind, because we do see these a lot where people want to, they own a property in their name individually and they want to buy property in an LLC, or they own it in one LLC, but they want to buy their replacement property in a different LLC. So this does come up a lot. But there is one exception to the rule that if it's a single member LLC and the business entity is not separate from its single member owner, then the underlying tax rate remains the same. So you can go from an individual to a single member LLC as long as it's the exact same ownership.
Yeah.
Right, yeah. So in that case, the entity does not file a separate tax return. It just becomes the one single member tax return.
All right, Rule 6 is 45-day identification period. We talked about this a little earlier, but it just states that from the date of closing, you have 45 days to identify at least one, if not more, properties based on those rules that Molly spoke on earlier. Again, this is that period that we will hold, that we have to hold the escrow funds for. This is the minimum time that we can hold them, and we'll send out, you know, documentation letting you know what they or the expiration date of that 45 days as well. So.
And then Rule 7 is your 180-day purchase period. This is your time to actually close on the property. And again, it starts from the day that we actually get, or excuse me, the day after that we get the funds from the relinquished property. That's when your 45 days starts, and that's when your 180 days starts. And it's just your time period for actual closing. We all know that sometimes things come up and closings can't happen right away, and things need to be mediated in between. So that's why they give you kind of a longer time period there to actually get the closing done.
And one thing I want to note about these two time periods, I know back in, it was either March or April, there was a little bit of leeway given to extend some of these periods through July 15th. And I don't know if y'all are, do y'all know if they've extended that at all?
I need to look. I noticed when I was reading that there's an exception to these rules on these timelines, and one is for a federally declared disaster. And as you know, we had a massive hurricane, so there's going to be some rules around that. And I would suspect, and maybe Christy knows, that I would suspect there could be rules around COVID as well, no doubt. You know, so check. If you're running up, check. There might be an exception.
Right. Outside of that, though, it is important to let your clients know that these are very strict timelines. The IRS does not care what the circumstances are outside of a natural disaster, with a few exceptions. They do not care why you got didn't buy a property until the 46th day, or why it's taken 182 days to close instead of 180. You have to abide by these, otherwise tax deferment is not going to go through. So next slide, direct deeding. Just real quick, this is achieved by deeding your property directly to the buyer rather than through the intermediary, as I said earlier. This is documentation we'll prepare, have you and the buyer sign a closing, or your buyer, you and the seller sign a closing. It just cuts down on the amount of deeds that have to be recorded, and less confusion, makes it simpler. I guess it was a common practice back in the day to have it go through the intermediary. Then the intermediary has to deed it to the buyer, and just more recording fees, more chance for error. So this is one of those methods that makes the process a little bit simpler. Not a lot when dealing with the IRS.
Okay, our fees. We charge, Carroll Hudson charges an $800 flat fee. This is from start to finish. This covers the replacement property and the relinquished property and the replacement property, as well as wiring fees, documentation prep, and escrow fees. And that is all we have.
And you got anything you'd like to add, or do you have any questions, or how do we?
Yeah, I'm going to speak a little on 1031, but I'd love for Christy to go ahead and get our slides together. Christy is on the call as well. She is our firm expert for opportunity zones, but I'm going to follow up to that 1031. You know, I agree with everything. Good job. I mean, it's good always to hear those refreshers. As CPAs, we really just kind of see it on the end, either the very beginning, does it work, does it make sense? And then at the end. So I don't really typically get involved in the 45-day and those 3 rules relative to the 45-day. But I have been on certain calls, especially, you know, you mentioned like kind and same owner. I have seen situations where I have a big outfit that group of doctors that owns a building together, and they were going to be taxed on the sale of this building, this beautiful building. And some of the doctors wanted to take advantage of the 1031, but they didn't own it in their individual names. They owned it in a partnership. And so I did tons of research for one partner to see if we could do a drop and swap. A drop and swap is where you drop the property out of the partnership, and then each partner can go do what they want with their share. Because, you know, like you said, you cannot do it in a partnership. You have to own it individually, or the ownership has to be the same. Ultimately, the doctors all got together and decided it was too risky to own it outside of the LLC, so the drop and swap, meaning drop the property out of the partnership and then start swapping individually, was not done. It is a bit risky. I ended up calling some experts in South Florida because there are certain things you have to hold it, like that 2-year period like we talked about, and it just, they were about to sell and it was just too risky to, you know, move forward. So one thing that I was asked to talk about was Delaware Statutory Trust, and honestly, I've not seen them. I just was interested in them, and in reading about them, I did discover, like you talked about, that they're the same as a 1031 with respect to the 45-day rule and the 180-day rule, and identifying the property and the deferral of the gain. But different than that 1031, the DST has these elements to the right where you talk about the sole owner. You know, with that doctor, he was, what you're doing is taking your gain property and reinvesting in sort of like I don't want to call it a mutual fund, but a trust or a REIT type entity, where this is what people do, where you take your gain money and go put it in a vehicle that allows you to defer that gain. And in this situation, it's different in that you're not the sole owner, you're not the property manager. It's almost as if you're just trusting your funds over to someone else that will manage it for you. Still have to meet all those rules you talked about, but they're in charge. I'm not aware of anyone that does this locally. I know that on the internet there's several groups. I'd be interested to see if any realtors have, you know, heard of this or done this with anyone locally, or if they're using people elsewhere. But it is an interesting concept if somebody just does not want to deal with the stress of owning property and they want to do it more like an investment deal where they kind of step back and are hands off. All right.
I have a quick question about the members on the LLC. I guess this is more around the 1031. But what happened if members drop off or are added to the LLC? Is that okay?
Well, the thing is, the LLC owns this property itself, and members came and left, and we did all sorts of tax planning on step up in basis, 754, other non-1031 exchange details. But ultimately, if the entire group wanted to do a 1031, they could, and then go into a new property, but not everybody wanted to. Some were ready for their cash, but some weren't. And so that's when the drop the property out and start swapping comes into play. So you just can't do it in the LLC if everyone doesn't want to, because like you said, you have to go from LLC to LLC. You can't go from LLC to individual.
Yep. Okay.
I'm actually doing a drop swap right now for another client. So
oh, cool.
There's
cool.
And to that point, I mean, if you have questions, give us a call. Give Anne-Marie a call. You know, there's different ways, you know, to go about it or to find a solution to the problem. And, you know, we're happy to help and sit down and talk with you about that and figure out what the best strategy is to help save some money and save on paying taxes.
Yeah.
Great. Thank you.
Thank you.
So, Anne-Marie, can you see my screen and the slides?
Yes, I can. I can.
Okay.
Will you go back one slide?
Yes, that's what I was going to ask you.
Okay, thank you.
Oh, I'm going the wrong way. Hold on. There we go.
So I'm Anne-Marie. I'm local here in Panama City. I'm a CPA. I work with Keith on things, and graduated from Florida State. I actually graduated from UF as well. Went for accounting down in UF. And just, I mean, I have 4 kids and just enjoy Panama City. You may have heard me talk a lot about hurricane stuff. I was very much involved in the hurricane disaster rules. If you don't know about them, call me. You should, because they would save you tax. But, you know, I'm just here to help locally love Panama City and want to see the best for Panama City. But I knew, you know, when Keith mentioned talking about 1031s, I thought, well, yeah, I got that, but opportunity zone is not my expertise. And I would like to introduce you to Christy. Christy, if you'll go to your slide. Guys, Opportunity Zone magazine, a magazine has named her the best of the best. She taught a webinar for CRI. Christy is on the call as well, and she is in South Florida, Bradenton area. And I met her initially through COVID-19. The firm did a lot of stuff relative to, you know, PPP loans, and Christy and I were in charge of credits for paying employees relative to if they got COVID. There's also some credits for you as self-employed realtors that you probably aren't seeing yet. You will see when you get to your individual tax return in January or February. But we met through that, and so when Keith called and said, hey, and he mentioned opportunity zones, I thought, well, there's no way Christy's the person. So Christy, you know, you went to UF as well, but then graduated out in Texas as well. I'm curious if we even crossed paths in Gainesville, but she's just a great friend virtually. And if you'll go to the next slide.
You want me to go back to the 1031s?
No, I want them to see this. I mean, she's just good, y'all. She knows the stuff. So it's a resource within CRI that you can contact me and we can get you in touch with the best of the best relative to opportunity zones. We will not be here, you know, for hours on end. We want to kind of big picture discuss opportunity zones. But if it gets complicated, just know that Christy knows it. So, Christy, if you'll go to the slide that kind of introduces the difference between 1031 and opportunity zones.
Is it this one? No.
Next, this one right here. Yeah, so Keith talked about 1031s, and Christy is going to talk about opportunity zones, but I thought it might be nice to have an opening kind of difference. What does this mean? I'm an accountant and I do it all day long, but, you know, for a non-accountant, what does it mean? So as Keith said, you're supposed to do your entire proceeds in a 1031. That is different in an opportunity zone. And again, Christy will go over those very detailed. But in an opportunity zone, it can be some or all, and it really ties back to the gain, the capital gain relative to your property. Under a 1031, we discussed it needs to be like-kind. With an opportunity zone, it just requires that it be an active trade or business, but the key is that it needs to be located in an opportunity zone. And so you say, well, what is that? If you have not heard of opportunity zone, you can go to CRI's website. There's an interactive map. And under that, just generally, I can tell you, the property must be located in a certain place. You know, and these places are all over the United States. Specifically for Panama City, and I'm just going to speak to the area that I just off the top of my head remember very well, is south of 15th Street towards the marina. So start at 15th, go south towards the marina all the way over to Millville. A lot of that property is opportunity zone property. I don't recall if there's beach property. I think there is, but the main that I think of is downtown Panama City. It is opportunity zone, and so is Millville. I even think parts of Gulf Coast College area and the port are as well, but there is a full interactive map. So that's the kind of property we're talking about. We're not talking about, you know, 23rd Street. This is south of 15th. I don't think there's any on 23rd Street. If so, it might be towards Callaway, but it's supposed to be, you know, distressed areas and encouraging people to come in and improve them. Another difference between a 1031 and an opportunity zone is the tax on the gain is deferred in a 1031, meaning you push that gain down the road. It is eventually taxed unless you die. I mean, if you were to die, you could get a step up and never see the gain. But the intent of a 1031 is to kick it down the road. That's not the same intent on an opportunity zone. The tax on that initial gain is still taxed. And I have a little asterisk there because Christy's going to tell you some rules about how it's not taxed at 5% and 10% on this year, and there's very specific rules. But generally, it's different than a 1031, and the 1031 talks about that initial gain not being taxed until later, while in opportunity zone, it is still taxed. Well, you say, well, what am I doing? Why am I even doing this? It's the next step that's huge. In a 1031, that second property that you reinvest is taxed when you sell it. So the first gain is deferred, and then if you sell, it's taxed. An opportunity zone, that second property, so you have gain property, you invest, that is still taxed, but that second property is not taxed. The appreciation, so I have the appreciation is not taxed if you hold it for 10 years. So the idea is if you go into downtown Panama City, buy a building, invest in that building, improve that building, and you hold on to that building for 10 years, say it appreciates $1 million. That $1 million appreciation, assuming it is appreciated, is tax-free. I will say, and Christy and I have calls with people in Panama City on this very topic. Opportunity zones are great when the stars align. When they don't align, it isn't great, and I don't think it's for everyone. But if you have somebody that has big capital gain property and is interested in investing and improving an area, specifically maybe in downtown Panama City, just think about opportunity zone. It's probably something that makes sense. So with that, I'm going to let Christy kick it off with very detailed discussion about opportunity zones.
Thank you very much, Ann. So it's nice to meet everyone. Like Ann said, I'm gonna do like a 10,000-foot level because it isn't the easiest thing to grasp. It takes a little bit of due diligence and studying. Because we have a short period of time, I'll go over it at a high level. And if it sounds like it's something that you want to do, I would highly encourage you to go on the CRI website and go watch we have a full hour webinar that really does go in deep and explain all the rules and intricacies around it. I mean, they do have, silly things about, there's certain sin businesses that can't be run in it. And so you really do need to fully understand it if you want to pursue looking at overlaying this on a purchase of a property. One of the things that Ann mentioned is that the difference between 1031 and opportunity zone, you're pushing a capital gain into this opportunity zone asset, and it's any gain. It can be short-term, it can be long-term, it can be selling stock. It does not have to be like kind. And a lot of people find that as a great opportunity, hence the name, to be able to defer those gains over a period of time. So if you look at, this is a timeline that we built, that it takes you through all the different events in a property that you're purchasing in a qualified opportunity zone. So the first event is when you create your gain. You sell an original asset. Let's say you sell it for $15 million and you have a realized capital gain of 10 million, right? So the next thing you do is you invest your capital gain into a qualified opportunity fund. But you have to invest the $10 million, which is the capital gain, not the proceeds, within 180 days after that sale that triggered that capital gain. That capital gain is deferred until no later than 12/31/2026. So you don't pay tax on that capital gain, right? But come the end of 2026, you will have to pay it. So, and I'll take you through the different milestones, but what you do need to be careful of that 12/31/2026 date, because in order to get it to the 10-year holding, you'll have to go past that date. Then in 2024, you have a 5-year basis step-up milestone. So 10% of your basis will step up. So you have a reduction of that deferred capital gain to $9 million instead of $10 million. And then if you go forward to the 7-year basis, you've held it 7 years basis step up, you get an additional 5% basis step up, which reduces your deferred capital gain to $8.5 million. So they tried to put milestones in here to encourage you to hold it, but also realize that some may not be able to make it to that 10-year mark. So then you also have a milestone at the end of 2026, that $8.5 million deferred gain has to be recognized no later than 12/31/2026. You do have to make sure. So if you see the timeline, this is the easiest way for me to lay it out. You do have a cash flow issue you have to think about. You need to have that tax available, the cash dollars to pay that tax when you hit the end of when you get to the end of 2026. So that gain on the original capital investment of 10 million, it's reduced by 1.5 million because you made it past the 7-year date. So it steps up, but you do have to include the 8.5 million in income in 2026. If you continue to hold the property past that and you make it to the 10-year mark, I feel like I'm saying that, you know, you make it to the next level of Jumanji. You make it to that 10-year mark, then this is the real benefit of the opportunity zone investment. That 10-year mark has an exclusion clause to it that if you, let's say after that 10 years, you sell that property for $20 million and you have a realized gain of 10 million, you do not have to pay tax on that $10 million capital gain. So that's what what Ann was referring to when she said, you know, the appreciation in that second property, if you hold it past the 10-year mark, you do not, it steps up to fair market value at the date of sale. You do not have to pay capital gains tax on the appreciation of that second property. So rule of thumb is you always have to pay the tax on the first gain that you pushed into the second property, but you do not have to do it on the second gain if you make it past the 10-year mark. The other thing I like to explain to people about qualified opportunity zones, it is a social investment. When Congress went about creating these, their intent was to create jobs in those areas. That is really their underlying intent if you read the notes to when they passed that law. So you'll find in the rules for qualified opportunity zones that in that property, it has to run a trade or business. That is part of the qualification. And a really good example of that is I had a lady come up to me in one of the webinars where I was presenting, and she said, so I want to build this building in this area, and I want to run a call center in that building. That's the business I want to run in it. And I looked at it on the map where it was, and I kind of knew the area, and I said, well, you know, that's actually kind of perfect, because the people that would do those jobs in that area could walk to work, and that is definitely the market for those kind of jobs. So that, you know, you have to think about the stars aligning, that, you know, whatever's going to happen in that building, there has to be an operating trade or business. So this is a qualified opportunity zone scenario, and it takes you through the math of it. It says that Annie sells a property with capital gains of $10 million. That property could be stock that she sells. And she invests it in a qualified opportunity fund on 12/31/19. She holds it for 7 years in that property. On 12/31/26, she gets to reduce her basis to 8.5 million, and at 20% tax on capital gains on that December 2026 date, she pays 20% capital gains, as long as that's the capital gains rate then, and it's $1.7 million that she would owe. If she holds it in that fund past 12/31/29 to past the 10-year mark, and it's sold for $20 million, you take the 20 million less the 8.5, she has a capital gain of 11.5 million, because she's already paid tax on that 8.5, that becomes her basis. But because of the 10-year rule, she gets to step the basis up to 20 million, and she owes nothing on that sale. So there's 3 tax benefits for a taxpayer who has a capital gain from a sale or exchange. It does have to be with an unrelated person or entity, and there's rules underneath that. If they invest an amount equal to the gain, and you could do more if you wanted to, in that qualified opportunity zone during the 180-day period, There's a permanent exclusion of the 10 to 15% as you hit those 5 and 7 year milestones. And then there's the deferral of the original capital gain until December 31st, 2026. So you have the time value of money that you get to hold on to your cash. And then there's the permanent exclusion once you go past the 10-year mark. Now that exclusion only lasts until 2047. And hopefully Congress leaves it there. So, if the investor has a capital gain of 10 million, without the opportunity zone, they're facing a 20% capital gains tax of $2 million they have to pay right when they sell it. If they push that capital gain in, they can use the $10 million to invest in either a qualified opportunity zone business or a business property. If they sell it within the 5 years, right, they hold it 5 years, the basis in the investment increases by 10%, and they sell it for $20 million, they get their basis is $1 million, they have a $19 million capital gain on the sale of the qualified opportunity, right? If they sold their qualified opportunity fund at the 7-year mark, they get a 15% basis, right? So then their basis is 1.5 million. Then they're gonna have an $18.5 million capital gain. So they do get a little credit, but it's not a huge amount. The original capital gain cannot be deferred past the 2026. I cannot reiterate that enough. I really try to make sure everybody understands where the cash points are that they would have to have cash to pay their taxes. And once they get past that 10-year mark, they are able to defer those capital gains. So let me, I think this probably goes through the same exact example, so I won't do that again. I'm gonna go further into my slides from, so this is where it tells you that it's any type of capital gain, right? So it can be stock, which is very attractive to people. It can also be Section 1231 gains, those net 1231 gains. There are 3 primary tests that it has to follow. It has to have an organization test, a purpose test, and an asset test, okay? And since we have some attorneys on the phone, that's why I thought I would show you guys this real quick. The organization, it has to be as a corporation or a partnership for tax purposes. So it can be an LLC, but it has to be taxed as a corp or partnership. It can be an S corp. It can be a public fund. So you will find in the investment brokerage houses that a lot of them have qualified opportunity funds. So I have given, talked to different clients about, do you want to create a qualified opportunity fund on your own, or is this something you want to push your gain into one of the brokerage houses and let them deal with all of the parameters of making sure you stay certified as a qualified opportunity fund. And that picking that type of entity for corporate or partnership, it's all based on the same choices and reasons that you would go through if it wasn't a qualified opportunity fund. So if it's an operating business, should I really be in a corp instead of partnership, versus if it's property that's going into it, should it be in a partnership? The purpose test, I think people make this part harder than it has to be. The purpose test, when you form that qualified opportunity zone and you're investing in the property, the entity that you create, that partnership or corporation that's the qualified opportunity fund, it has to send in a form with its tax return. It's called the 88996 form, and it's a self-certification. And one of the check boxes that you have to check is that the company attests its governing documents include a provision that the purpose is to invest in qualified opportunity zone property and description of the qualified opportunity zone business. So when you create, the attorney, when you create those originating documents, the organizational documents, you have to put in the purpose section that it is specifically for qualified opportunity zone property. And it's not as hard as it sounds. I just need to be able to see that it says qualified opportunity zone, that's the whole purpose of the entity. This one is the little bit trickier one that people kind of have to really slow down and look at to make sure they understand it. So at least 90% of the qualified opportunity fund assets, and you can measure it every 6 months, because you will have assets sometimes in these funds that go in and out, consists of 3 types of property. It has to be one of the 3: qualified opportunity zone business property, which means an asset, a building, something that is in that qualified opportunity zone. It has to be qualified opportunity zone stock. So if you have tiered entities, it needs to be a QOZ stock or partnership interest. And this is an example of a structure where you have different tiers. And I'm happy to send the slide deck to the whole webinar that's online. And you can probably go online and listen to the webinar and hear this in more detail because I'm going a little fast. So let's see. The business property has to be tangible property. So here's the part. It has to be used in a trade or business. And either the original use of the property starts with the qualified opportunity fund ownership, or the qualified opportunity fund makes a substantial improvement to the property after the date of acquisition. And when they say, so if you buy a building on a piece of land and you're going to substantially improve it, they say you have to double the adjusted basis of that property. So you have to make a substantial improvement to that property. And I mean, you guys are in an area where you have you're prime for doing something like that, because a lot of those properties do need substantial improvements in those zones. One of the things that I will say about trade or business, there are sin businesses that they don't allow, which is in the next slide. I'll show it to you. But you know, one of the things that doesn't qualify as a trade or business is a property that you're leasing out, a commercial property, and you're leasing it out, and they're triple net leases. Okay, they view that as an investment, not a trade or business. So that's probably the trickiest thing you have to be careful with dealing with properties. It can't be a triple net lease, meaning the lessee is responsible for the property taxes, all the expenses, and there's not really a service being provided to those tenants. You know, if they have CAM and they have all common areas that you have to maintain, it starts to help with that argument that it's a trade or business. So here's the sin, you know, businesses. It can't be for a private or commercial golf course, a country club, massage parlor. Can't make hot tubs or suntan booths. It's not for a racetrack or gambling, and cannot be for the principal business of sale of alcoholic beverages. Like, it can't be for an ABC liquor store. So, and I know that's a lot. Does anybody have any questions? I tried to keep it simple and get enough in there that you guys have a gist of how they work, so that it at least, you know, if you're talking to someone and they have a capital gain, it at least helps you to go, you know what, you really need to look at this, and that's a possibility.
Hey, Christy, real quick, this is Keith. What about if there's any revenue generated from the property throughout that 10 years? Do you get a tax break for any of that, or is it just counted regular income?
Yeah, you just treat it as, it's just as if you were operating as a business or
Okay.
renting, or, yeah, you don't get any tax breaks for that. It's literally just on the capital gain deferral.
Thank you.
Mm-hmm.
So Christy, did I understand it right? So when you hit the 7-year mark in the opportunity zone, do you have to pay some tax, some capital gain tax on that initial investment?
So no, you don't have to. If you continue to hold it, all it does is, as you hold it at that 5-year and 7-year mark, you get to step up your basis, meaning they forgive some of that original deferred capital gain.
Okay.
And when you eventually get to either December 31st, 2026, or or when you sell it, prior to that, you would get that forgiveness of that initial capital gain. And you know, that's why we showed the example. If I sell it for 20 million at the 7-year mark, and I made it to 7 years, and the original capital gain was 10, well, I get credit for $1.5 million that I get to take as basis against that. And I don't have to pay on $1.5 million worth of capital gain from that first $10 million capital gain.
Okay.
So Christy, if you meet the otherwise test for estimated tax payments, do you say December 31st? So is it really due that April, or do we need to be cutting checks at December 31st?
Oh, you mean for estimated taxes? Well, I mean, I think you do have to follow when, for December 31st, I think you would have to make sure you pay it in that fourth quarter payment in January. Because it's, you know, you still get to follow the safe harbor rules. So if your year prior was less, you may have till April, but it's going to depend.
The whole point is that's the tax year it falls in.
Correct.
Okay.
Right. And there's some rules about when you, on the front end, when you have that deferred gain, you know, all of this deferral happens at the partner or shareholder level. So if you have a gain that happens inside of a partnership, but you don't find out about it till year end, and it may have happened earlier in the year in the partnership, they will allow you to use the end of the partnership tax year as your starting date to count to 180 days to reinvest it. So they give you a little break because you may not have knowledge.
Okay.
There's
Well,
a,
Christy, awesome job. I really appreciate it.
You're welcome.
Yes. So does anyone have any questions? You can type it in the chat box. Anything about 1031s or opportunity zones? We'll see if anyone types a question in. Ryan, was there anything that you had in, you know, kind of anything that you wanted to add from a financial lending standpoint on that?
No, I mean, for me, when it comes to 1031s, it's pretty straightforward. I mean, because the title company holds in escrow all the money that's being used for the 1031. So as long as we can get proof of that, then that's the money that's being used for the down payment and funds to close. So from a lending standpoint, it really doesn't affect the mortgage at all. It's just a pretty straightforward process, just like any other transaction would be.
Okay. Well, I don't see anyone asking any questions. Did anyone else on here on the panel want to add anything, or? I guess not. Okay. Well, I appreciate everyone taking your time out of your busy day. I know it's a Friday, so it's asking a lot. I really appreciate it. And thank you.